low here. The S&P still very much within reach for a positive day. Joining us, Liz Ann Sonders and Cooper Howard into the bell for a big picture discussion. Liz Ann's the chief investment strategist and Cooper's a director and fixed income strategist at Schwab's Center for Financial Research. Afternoon, guys. Good to have you both here. Liz Ann, get us started as we were on this epic run for stocks. We're almost like full circle back to the highs. Not quite there, but, how has the market shifted from 2 weeks ago? It must look totally different than we did at the lows, right?
Oh, sure. And the lows were very much an intraday phenomenon. I think, Oliver, you and I talked about it already, but, on that fateful August 5th day, you had a record-breaking intraday surge in the VIX, and the same exact day you had a record-breaking decline intraday in the VIX, and you saw sort of a classic V bottom come in, particularly when J.P. Morgan came out on that Thursday, 3 days later, saying their perspective was that 75% of the carry trade had been unwound, and we've been sort of off to the races since. I think a day like today really is probably just about the fact that we had 8 days in a row up, and you just see some profit-taking kick in. There's no particular news to define today's weakness. We also had a near and dear to my heart, a Zweig breadth thrust. So I worked for Marty Zweig in my first 13 years, and those are positive in terms of technical indicators, but you do tend to see some short-term volatility in the immediate aftermath. Maybe another reason for some weakness today.
That breadth thrust was coming out of the low, or was that this past week?
No, just recently.
Okay, so those couple days where we had real good participation, that's usually like a pretty darn good. Didn't we get like a big breadth thrust, like basically around like the October low from 2022?
Oh, yeah, for sure. In fact, what was interesting about that low is the indexes at that point were taking out their June lows, but under the surface, there had been a notable breadth improvement. So to use technical terms, that's a positive divergence. And that was a much healthier underpinning for the market than what we had seen in that prior June period.
Okay. Yeah, I think that was if I recall, our Mike McCurr was labeling it as the Whaley breadth thrust. So I don't know if it's the same breadth thrust, but breadth thrusts in general are good. It means a lot of things are working. Cooper, does it look like the credit markets, they never really freaked out in a big way, right? Like this was largely an equity event, or has there been as much volatility in credit to normalize?
You haven't really seen as much volatility in the credit market. So you saw spreads spike quite a bit once we kind of hit that Monday issue that came up in terms of the payrolls report that was a little bit weaker than expected on that following Friday, and then everything with the yen carry trade. But since then, Oliver, you've really seen spreads kind of decrease a little bit. They are still relatively tight. So if you look, though, at the all-in yield for investment-grade corporate bonds, we do think that it is an area of opportunity. But one of the risks, one of the issues is that spreads are relatively tight. So that doesn't really give too much wiggle room, if you will.
Cooper, when you're looking at the slate for this week, Treasury yields are holding that first week of August low, but the dollar's already broken down. Where's the momentum? Is there momentum in Treasuries that is identifiable at this point?
I think the momentum is going to be dependent upon what Powell says on Friday. I think that that's going to be the big catalyst for what happens this week. Now, we know that we have Fed minutes tomorrow. We also have jobless claims on Thursday. But I think the big catalyst this week is what comes with Chairman Powell's speech at Jackson Hole. Now, our expectation is that he's likely going to say that he's comfortable cutting interest rates, or they're going to be closer to cutting interest rates. Give some indication to the market that we're moving more towards a rate cutting cycle. So that's what we would be expecting.
Okay. Liz Ann, when you look at the stock market relationship to bonds right now, does it look like the two have kind of like formally disconnected? The equities seem to have so much more direction right now.
Yeah, I think the equity market has really swung from a significant correlation on the interest rate side of things to more now a correlation on the economic data side of things. So as we've seen in the last week or so, we've been in this sort of good news is good news. So, and frankly, I think that to some degree is reflected in thinking around the Fed. Not that they've put inflation in the rearview mirror in terms of what they're focused on with regard to policy decisions, revisions, but they have been emphasizing the labor market. So bringing into sharper focus the other part of their mandate relative to the hiking part of the cycle, where it was solely a function of inflation.
So then, is this a market that if it doesn't get exactly what it wants from Powell, we should be all right, Lizanne? Or what's kind of the tolerance range you think for this week?
Well, we've got the benchmark revisions coming from the BLS tomorrow, and of course that predates the Powell speech at Jackson Hole. So it could be a pretty interesting week, particularly if the downward revisions, which are expected, are outside the band of expectations, meaning worse than expected. I think that could change the narrative a bit near term.
Okay. Cooper, last thought on bonds. It seems like you still think munis are a win-win.
Yeah, I think that they're showing more of a attractive opportunity for the muni market, especially relative to the corporate market. So one of the metrics that we look at, Oliver, is just what is an all-in tax rate that's required to make a muni yield equal to a generic corporate bond yield after taxes. Because as we know, municipal bonds pay interest income that's usually exempt from federal income taxes. So right now, that all-in yield's about 35%. That's near the low that it's been over the past 2-year range. So we do think that they are showing a little bit more of an attractive opportunity. Also, it tends to be that the average muni has a higher credit quality than the average corporate bond. So that's another reason why we think that it relates to one of the reasons why we think clients should stay up in credit quality. So it ties into that theme that we've been discussing recently.
Understood. Okay, makes sense. Overlaps in a few good places. Excellent. Great stuff. Thank you guys. Lizanne Sonders, Cooper Howard. Great teamwork.